Hello everyone, welcome to Be Smart. Let's talk about finance. Finance is a term for matters regarding the management, creation, and study of money and investments. It involves the use of credit and debt, securities, and investment to finance current projects, using future income flows because of this temporal aspect. Finance is closely linked to the time value of money, interest rates, and other related topics. These are the key of finance term: asset, liability, balance sheet, cash flow, compound interest, equity, liquidity, profit. These are the key of finance term: asset. An asset is something of value, such as cash, real estate, or property. Liability. Liability is a financial obligation, such as debt. Liabilities can be current or long-term. Balance sheet. A balance sheet is a document that shows a company's assets and its liabilities. Cash flow. Cash flow is the movement of money into and out of a business or household. Compound interest. Unlike simple interest, which is interest added to the principal one time, compound interest is calculated and added periodically. Equity. Equity means ownership. Stocks are called equities because each share represents a portion of ownership. Liquidity. Liquidity refers to how easily an asset can be converted to cash. For example, real estate is not a very liquid investment because it can take weeks or months to sell. Profit. Profit is the money left over after expenses. A profit and loss statement shows how much a business has earned or lost for a particular period. These are the type of finance: public finance, corporate finance, personal finance, social finance, and behavioral finance. Public finance. The federal government helps prevent market failure by overseeing the allocation of resources, distribution of income, and stabilization of the economy. Regular funding for these programs is secured mostly through taxation, borrowing from banks, and insurance companies. And earning dividends from its companies also help finance the federal government. Corporate finance. Businesses obtain financing through a variety of means, ranging from equity investments to credit arrangements. A firm might take out a loan from a bank or arrange for a line of credit, acquiring and managing debt properly can help a company expand and become more profitable. Personal finance. Personal financial planning generally involves analyzing an individual's or a family's current financial position, predicting short-term and long-term needs, and executing a plan to fulfill those needs within individual financial constraints. Personal finance depends largely on one's earnings, living requirements, and individual goals and desires. Social finance. Social finance typically refers to investments made in social enterprises, including charitable organizations and some cooperatives, rather than an outright donation. These investments take the form of equity or debt financing, in which the investor seeks both a financial reward as well as a social gain. Behavioral finance. There was a time when theoretical and empirical evidence seemed to suggest that conventional financial theories were reasonably successful at predicting and explaining certain types of economic events. Nonetheless, as time went on, academics in the financial and economic realms detected anomalies and behaviors which occurred in the real world but could not be explained by any available theories. Careers in finance. Working in the financial field can be an exciting and profitable career choice. There are many roles you can fill in the finance industry, depending on your experience and skill set. For example, accountant, auditor, banker, capital manager, market analyst, and insurance agent. Lastly, thank you for watching Be Smart.